That time of the year again when the stock market doom merchants are at their most vocal as they focus on the historic apex of the darkest month for stocks of the year, October the 19th, now the 29th anniversary of the 1987 Black Monday stock market crash that few saw coming, but ever since many expect to repeat. So regardless of what the stock market has actually done thus far, by this point of virtually every year the perma bears can always be seen literally jumping up and down like demented rabbits, proclaiming that a crash is once more imminent as they point to a myriad of harbingers of the stock market apocalypse. So it's no wonder that October tends to be an unusually irrational month for where stock market expectations are concerned, and never more so than this year, given the chaos of this year's US election cycle that probably features the worst two candidates in US election history, which ensures that America loses no matter who wins. So doom once more prevails, despite the fact that if this time stocks do by chance crash, that every crash in the general stock market indices such as the Dow, S&P, FTSE have always resolved in the mother of all buying opportunities, as I will cover in this three-part series, which is in addition to my Machine Intelligence Megatrend Investing series. So ensure to also watch those videos as they are published. So firstly, in this video I'll demonstrate how to actually trade a stock market crash. Not just any crash, but the mother of all crashes, that of October 19th, 1987, that provides for some very valuable real-world trading lessons that are just as valid today as they were near 30 years ago. Back in 1987, the stock index futures markets were in their infancy, and markets such as for the Dow Jones Industrial Averages did not even exist. The only way a small-time trader such as myself could gain exposure to such futures markets was via the likes of IG Index, a spread bookmaker which offered the facility of trading the future markets at an affordable level of risk. The three key elements were, firstly, small position sizes of as little as £2 per point. Secondly, all of the commission was included in the spread between the buying and selling price. And thirdly, IG offered guaranteed stop losses so that the risk was absolutely controlled at a little extra cost included in the spread. Stop losses are a critical element of successful trading, as you have to know when you are wrong, and the best way is for the market to tell you that you are wrong by stopping you out of your position. Thursday, 15th October. Michael Fish is a weatherman. My expectations, given Wednesday's record 95-point drop, or 3.8%, that given stocks were still in a bull market, that the Dow was extremely oversold and should resolve to close higher on Thursday as it bounces off a new swing low. Therefore, my initial trading position of the day was geared towards a Dow rally. This trade was stopped out with a loss of £165, and later in the same trading session I took another chart trigger to go long, which I closed out with a profit of £100. So I ended Thursday with a small net loss of £65. However, I could clearly see that the earlier downtrend had weakened the Dow and was clearly targeting a trend towards the August low, as the Dow ended another day sharply lower, down 57 points or 2.4% at 23.55. So my expectations going into Friday were for another down day. Now, Thursday evening I recall watching Michael Fish, the BBC weatherman, state that someone had called the BBC warning that a hurricane was on its way, but he assured everyone that no such thing was going to happen.
Good afternoon to you. Earlier on today, apparently a woman rang the BBC and said she heard that there was a hurricane on the way. Well, if you're watching, don't worry, there isn't.
Good afternoon to you. Earlier on today, apparently a woman rang the BBC and said she heard that there was a hurricane on the way. Well, if you're watching, don't worry, there isn't.
Well, that statement has haunted Mr. Fish ever since and is a good lasting memory imprint from 1987. With storm winds buffeting the house on 180 miles north of central London, my expectations coalesced around Friday being another strong down day for the FTSE given the brewing weather and financial storms, so I expected stocks to continue to trend sharply lower. Friday the 16th of October 1987 and a hurricane hit southern England hard. The news reporting was full of the devastation across the south of England with power cuts in many areas. So much for BBC weather forecasts. And much of the City of London had failed to report for work and hence the UK financial markets were not fully operational. Perhaps as many as 60% of London's trading rooms were out of action. So I called IG Index half expecting no one to pick up the phone, but was pleasantly surprised that they were open for business. I shorted the FTSE twice during the day with expectations that the unexpected storm would be an additional negative downwards driver for UK stocks, in addition to the Wall Street's downtrend, and exiting both trades before the markets closed with profits of £305 and £30. Following Friday's Dow close, I was alarmed by the severity of the sell-off, which again closed sharply lower, down 108 points, another record one-day fall. Not only decidedly breaking the previous lows, but the downtrend was accelerating. So up until this point, despite the sharp daily falls, my perception was that I was trading in a bull market correction. The word crash had never even entered my mind, but I spent Friday night and the whole of Saturday pondering the change in market behaviour, and at some point a switch flipped in my brain when I realised that a stock market crash was now underway. Friday's 108 points plunge, its largest on record, also on record trading volume that followed Wednesday's record daily plunge, actually marked the start of a stock market crash that would mistakenly come to be known by all as the Black Monday 1987 stock market crash, when in reality actually began on Friday, because that's when it became obvious to me that a crash was underway. But being isolated from other market participants and commentators, I was not aware of the reasons why it should or should not crash, or what others thought was happening. Rather, the market that I had been in sync with for some time, i.e. trading both short and long side for some time, was now behaving completely out of character. And being a short-term trader, I was quick to adapt to this change in character because I was not carrying any of the baggage that is commonly referred to as technical analysis. I was a trader, not an analyst. I knew how to trade, and I only had very basic knowledge of technical analysis. Trend lines and support resistance levels was about as much as I knew at the time of the 1987 crash. But I was kicking myself for closing those two short FTSE positions out before Friday's close, for I concluded that if it was now obvious to me, a relative newbie to trading, I was only 19 years old, that a stock market crash was in progress going into Monday, then it must be obvious to everyone else in the world, i.e. all of the experienced city stock and futures traders. Therefore, I expected the futures would heavily discount the unfolding crash, and so how can I make any money by shorting the market on Monday's open? Anyway, after resigning myself to more or less having missed the boat by not keeping my positions open Friday, I decided that I would at least try a couple of shorts to ride out the already deeply discounted market on Monday's open, hoping that the futures will not be discounting too much of a drop. Maybe a couple of 100 points from the spot indices will still enable me to profit from an anticipated stock market crash climax. Monday, October 19th, 1987. Tell me why I like Black Mondays. Firstly, again understand that the stock market crash started on Friday the 16th of October and continued into Monday morning because people did not just suddenly wake up Monday to find the market in free fall, which is a valuable lesson that the crashes always come in crowd. Early Monday morning, I saw the FTSE open sharply lower, down about 100 points. So I sighed and called IG index and asked for the futures prices, expecting bad news that the futures will be discounting drops of several hundred more points for both the FTSE and the Dow, but they were not. They were discounting barely a 50-point drop from the spot indices, which meant that the market was not discounting a stock market crash. I immediately sold the Dow short at 22.27 and the FTSE short at 21.44. It's now midday UK time and I called the IG index up to move the stop losses and to lock in some profits. With IG index at the time meant free money up to use for further positions. The FTSE spot index was down over 200 points by now, but the futures price was showing very little difference to the spot price, so I shorted the FTSE some more at a price of 20.57. It's 2:40 PM and Wall Street opens. Well, tries to open, but the stocks are not opening due to the volume of selling freezing the market. Therefore, for a while, the Dow Jones index was giving a false price of only having fallen a few points. It's the lull before the storm. I give IG index a ring to find out what the prices they are offering with a view to shorting some more. Hi, could you give me a price for November Dow, please?
Yes, sir, it's trading at 20.45.
Good. I would like to sell to open £5 at 20.45 with a 50-point stop.
You want to sell?
Yes, sell. I've always wondered why the broker was surprised that I wanted to go short. Maybe looking at my account he thought I was already too heavily short. Maybe IG feared what was about to transpire and wanted to reduce the size of their book. Or perhaps people generally were so terrified to short the Dow after it had already fallen. I don't know, but the impression I got was of surprise on the other end of the line. I guess that's what market panic smells like to people who don't know what the hell is going on, one of confusion. So that was my fourth short open for the day at Dow 20.45. Meanwhile, the actual Dow Jones spot indication was down only 50 points at about 2200 due to the slow opening of individual stocks against the actual futures nearly 150 points lower. It's now 7:40 PM and the Dow is now down about 300 points, having rallied from being down 340 points about 10 minutes earlier. Having watched the market for the last 5 hours, I can tell that the Dow is gearing up for another bout of selling towards being down at least 400 points. So wanting to sell some more, I give IG Index another call. Hi, can you give me a price for November Dow, please?
Mr. Walliat, we are only accepting orders to close.
Damn. On another £10 per point, I could have made another grand on expectations for the Dow closing 400 points lower. So it's 8 PM and the Dow is hovering around 300 points down with an hour to go, and this is really nail biting stuff. I can't stand this. The broker won't let me open any new shorts and I don't want to liquidate. So I go out for a drive and return when the US markets closed at about 9 PM. It's now 9 PM and BBC 9 o'clock news rolls. Dow Jones closes down 508 points at 1739. Splutter, cough, splutter. 508 points. 508 points down. Wow, I'm rich. How much? I don't know, at least £14,000 rich, from an account balance of about £700 to £14,000 in one day. Okay, in today's money, £14,000 is not a lot to shout about, but to a 19-year-old in 1987, £14,000 was an enormous amount of money, especially as made in just one day. As an example, I could have bought a terraced house on a nearby street for about £14,000. Now, what to do next? No time or inclination for sleep. I need to work out a strategy for what to do tomorrow, as clearly the FTSE is going to be hammered hard and open sharply lower. This looks like a complete and utter collapse of the financial system. 580 points down? Not in my wildest imagination could I see the Dow Jones closing down 508 points. This crash is far bigger than that of 1929, which was about a 10% drop, not 22% in one day. Anyway, I decided to close the positions tomorrow morning, as I made the paper profits and now I need to lock them in. Tuesday, 20th October 1987, the big bounce day. As expected, the FTSE opened sharply lower and trades down by over 200 points by midday. Having watched the market trend lower and having withheld my decision to liquidate any of the positions thus far, I am now absolutely exhausted. By now, due to not having slept for over 24 hours and actually starting to feel a little dizzy, so I give the broker a call to get some prices with the aim of liquidating all of the positions whilst I'm still able to mentally function. IG has given me a quote of 1720 for the FTSE and 1570 for the Dow. Wow, these are excellent prices at deep discounts to the spot indices. So I decided to close the larger Dow position at 1570, somewhere where it will never actually trade in real life, and move the stops on the other three positions. I set the FTSE position stops at 1790 and 1800, and the remaining Dow short position stop at 1730, or just below last night's close and some 160 points above the current futures price. Well, Wall Street opens sharply higher and I'm stopped out of all of my positions. Exhausted, I was off to bed. So the outcome. In financial terms, I made a profit of about £12,300 virtually overnight, and in ego terms the increase was much larger. I was off floating into a fantasy land of becoming a millionaire by the time I hit 20. Following the stock market crash, speculation was rife that some of the financial institutions could go bust. Worried that my newfound wealth may evaporate, I withdrew more than 50% of the funds on account on the 23rd of October 1987. So an historic marker is set. Of all that has come to pass during the subsequent 29 years of my trading life, one major advantage I have had over most other traders is that I have a clear marker against which to compare methodologies and trading psychology. It may not have been always been clear, with so many holy grails of trading and analysis floating around out there, but I have always had the option of referring back to what I know with certainty actually works. So ensure you are subscribed to this YouTube channel for the next two installments in this series, The Real Secrets for Successful Trading and The Real Secrets for Successful Investing, and for my current series of videos into how to profit from the emerging machine intelligence megatrend that covers these listed key areas.